Hi, so now we're looking at Chapter 19, Cost, Volume, Profit Analysis. So in order to dive into this, we have to look at cost behavior. And cost behavior is the manner in which a cost changes as a related activity changes. And so we're going to look at that, what that means. So the more that you drive your car, the more gas you use, because the more miles you drive, the more your gas, or the quicker your gas will leave. So understanding the behavior of cost depends on the following. The first is identifying the activities that cause the cost to change. So in the example we just used, it's miles driven will cause your total gas amount to change. So these activities are called activity basis or activity drivers, what drives the cost. And then specifying the range of activity over which the changes in the cost or interest are of interest. So this range of activity is called the relevant range. So from here to here, my costs are going to act in this manner as long as I stay within this relevant range. So costs are normally classified as variable costs, fixed costs, or mixed costs. And mixed costs would be a little bit of fixed and variable. So variable costs are those costs that vary in proportion to the changes in the activity basis. So it will be like your direct materials or your direct labor hours. The more units you make, the more direct materials you need, and the more direct labor hours you'll be assessed. So looking at this company here, we'll see what it means to be a variable cost. So if we produce 5,000 units, they're $10 a unit, but our total direct material cost is 50. But if we make 10,000 units, it's still $10 per unit, but the overall cost is going to increase, it's going to double. So although the unit cost remains the same, the variable total cost is changing. And so this is what a variable costing graph looks like. The more units, the more amount your cost will be, but the rate stays the same and it's flat. But we're looking at what the total cost will do. These are some examples of variable costs for universities, airlines, and their activity base. What drives their costs? Fixed costs are costs that remain the same no matter how your activity base changes. So it's a straight line and it stays the same, it stays static. So things such as your depreciation or your rent will be considered fixed costs. And so we look at this. So the manager or the supervisor of this department makes $75,000 a year. So whether we make 50,000 bottles of perfume or 300,000, Jane's salary will not change. And so this stays the same. However, if we did a per unit cost, our per unit cost would decrease because the more units you make, the lesser or the more you spread this across. And so the graph for that is, this is our main graph for our total cost. Fixed cost stays the same. It looks like the variable unit cost, but then our per unit cost does this decline. And then these are the same types of businesses and their activity bases with the types of fixed costs that they have. So we're gonna look at a method of reporting called variable and fixed costs. We're going to look at a method of reporting variable and fixed costs, which is called variable costing. And so variable costing is going to be a little different than what we're used to. We learned what's called absorption costing in Accounting 1A. We didn't name it as that or label it as that, but it is called absorption costing. And that is when we learned our multiple step income statement. And so our multiple step income statement was sales minus cost of merchandise sold gives us gross profit, less operating expenses gives us net income. Now, within our cost of goods sold, we had the total amount of our product, DM, DL, and FO, which includes both variable and fixed costs. But under the variable costing, we're going to only include the variable manufacturing cost in our product costing. So that will be DM, DL, and variable factory overhead. And then the fixed factory overhead is going to be considered or treated as an expense for the period it's incurred. And so we do this just to kind of look at our cost behavior. Now, when we actually report based upon GAAP, we don't use this method. This is really just an internal method for managers to look at their costs. So variable cost, fixed cost, and mixed cost. So mixed cost is the mix between two. So what mixed cost is, you have a variable piece and a fixed piece. And the best way that I can explain it is when cell phones used to be priced this way. You had a flat rate for so many minutes, and every minute over that you had a per unit rate. So that's a mixed cost. It has a flat portion or a fixed portion plus a variable portion. So now we're going to look at what's called cost volume profit analysis, CVP. And then it looks at relationships amongst your selling prices, sales and production volume, cost, expenses, and profits to help us with all of these various things. So the first thing we're going to learn, and you guys have to get this under your belt, is what's called a contribution margin. So our contribution margin is the excess of sales over variable cost. And it's computed as sales minus variable cost. And so the contribution margin is, what do we have left over from sales after we've taken out our variable costs that helps us to eat away at our fixed costs or contributes to decreasing the amount of fixed costs or eating away at our fixed costs? Because what we're going to learn is fixed cost is a sunk cost. So whether you sell 0 product or 100 product, you're going to be assessed your fixed cost. So we look at the contribution margin to see how much of our sales do we have available after we have our variable costs that we can use to eat away at our fixed costs. So contribution margin, first piece, sales minus variable costs. So assume the following data. So we are learning this new format called the contribution margin income statement format. So it is sales minus variable cost, and this is only your variable cost, gives you contribution margin, less your fixed cost gives you income from operations. So we see that after our sales, we have $400,000 to help us to eat away at our fixed costs before we make a profit. And we'll use this information to help us establish break-even points. We also have what's called the contribution margin ratio, also sometimes called the profit volume ratio. And so this is just another way of looking at how much do we have to eat away at our fixed costs, but it looks at the percentage of each sales dollar that we make that's available to cover fixed costs and to provide income from operations. And so our contribution margin ratio, and so for this chapter, we're gonna have a lot of formulas that you guys are gonna have to get under your belts. And so it is contribution margin divided by sales. So we just calculated our contribution margin. We know contribution margin is sales minus variable costs. So to get the ratio, we take contribution margin divided by sales. So what this tells me that is that 40% of every dollar that we make is available to eat away at our fixed So it's useful in helping us to determine if there's an increase or decrease in sales volume, how it's measured in sales dollars. So change in income from operations equals change in sales dollars times our contribution margin. So say for instance, we say we're going to add 80,000 more dollars in sales from selling additional 4,000 units. How much are we going to get in income from operations? And so what we do is we take the 80,000. We know that 40% goes to eating away at our fixed costs, and then that's what leads to our income from operations. So a change in income from operations would be 32,000. So 80,000 times the 40% tells me that my income from operations is going to increase by $32,000. So let's take a look. So notice we are now increasing our sales to 54 units, and it's $20, so that's 1.08. Our variable costs now increase because now we're 54,000 units, 648. Contribution margin is 432. Fixed cost is still 300, and so our income from operations is 132. Now remember, it was originally 100,000, and so now it's 132. So now the contribution margin ratio is just a quick reference that you as a manager can use this tool, that if you have certain amount of marketing dollars that you want to put towards your product, and you can kind of estimate how much should you see in your bottom line by using this contribution margin ratio. The other piece is the unit contribution margin, and this tells us how much of your selling price goes against eating away at your fixed cost. And so the way we calculate this is sales price per unit minus variable cost per unit gives you unit contribution margin. So we know our sales price was 20, our variable cost was 12, and so our unit contribution margin is 8. And we can use this to determine how many units we need to sell in order to change our contribution, our income from operations. So let's look here. Assumes the sales would increase 15 units from 50 to 65. So what would the increase in Lambert's income from operations be? We would take those 15,000 units. We know that each unit will bring an additional $8. And so our income from operations would increase by 120,000. So great measures of just quick measures to see if you make a change in one area of your business, how will it impact your bottom line? And so this is just walking through that analysis to show you here. Remember, it was originally 100,000, now it's 220, and we estimated that it would increase by 120,000. So that's cost volume profit analysis, looking at our contribution margin ratio, and our unit contribution margin. Now we can take those three elements that we've learned to identify what is our break-even point for a company. So companies want to know what their break-even point is. And we're also going to learn target profit to help them to set goals for their company. So a company break-even is when you operate neither at a loss or a profit. You have your cost equals your revenues equals your expenses, and you've made zero. So what would that be? So our break-even amount in unit sales would be fixed cost divided by unit contribution margin. So this will tell me how many units we must sell in order to break even. So companies may use this to assign different stores. This is how many units you need to sell this. This is how many units you need to sell at this. in order to determine break even, as well as we're going to see target profit here in just a second. So break even, revenues equal cost. So assume the following data. Fixed cost is 90,000. Selling price is 25, variable cost is 15, and unit contribution margin is 10. So the break-even point in units will be our fixed cost divided by our unit contribution margin. So it's 90,000 divided by 10. So this company must sell 9,000 units to break even. So we'll see here. 9,000 units at $25 is $225. Variable cost is 9,000 times 15, $135. Contribution margin is 90. Fixed cost is 90. Income from operations is 0. We can also determine how much dollars we need to make to sell in order to break even. And so our dollars would be fixed cost divided by contribution margin ratio. And we know contribution margin ratio is either your contribution margin divided by sales, or you can also calculate it a different way, your unit contribution margin divided by your unit selling price. So you have two ways of calculating it. So the unit contribution margin ratio for Baker is as follows. Unit contribution margin is 10, unit selling price is 25, so it's 40%. So the break even sales in dollars will be 90,000 divided by the 40,000 gives us 225,000. So we must sell 225,000 in product to break even. Now, what if we want to make a profit? You will do the same formulas that we just learned, but just add target profit. So notice this is, if we take off this target profit, fixed cost divided by unit contribution margin is how many sales in units we must make in order to break even. Well, if I want to make $10,000, I just add my target profit and divided by unit contribution margin, and it tells me how much units I must sell to make that target profit. So it's very simple. Don't make it very hard. It's just taking those three formulas we learned and just adding the target profit to it. Well, the two formulas we learned, adding the target profit. So let's look at this example. How many units do we need to sell to make $100,000? Because our target profit is 100. It's fixed cost plus target profit divided by unit contribution margin. Unit contribution margin is selling price minus variable cost divided by unit contribution, equals unit contribution. So this is where we got the 200,000 plus 100,000 divided by 30. Gives us 10,000 units. So we must sell 10,000 units to make $100,000 profit. So now you can task your different stores, like you need to sell this amount, you have to sell this amount, you have to sell this amount in order for you to meet your sales goals. And this is just a picture showing you how it actually works out. So a lot of stuff that we don't see behind the scenes, when maybe our managers have said, okay, this is our sales goal. Well, how did you come up with this sales goal? It's by looking at different items such as this. And then we can also see how many dollars we must sell in order to make $100,000 profit. So for dollars, it is the fixed cost plus target profit divided by the contribution margin ratio. We learned a new way to do the contribution margin ratio. And so it says we must sell $750,000 in order to make $100,000 profit. So that's if your company sells one product. What if we have multiple products? How do we know what our break-even sales should be? We look at a concept called sales mix. So what is the sales mix of the items that the company makes? So we're soon Cascade Company sells product A and B, and over the past year, this is what it has been. So they've sold a total of 10,000 units. Product A is 8,000, product B is 2,000. That gives us the unit selling price, the variable cost, the unit contribution margin, as well as the sales mix. So we can calculate the sales mix by saying, what is the total amount of units that I've sold? So we see product A is 8,000, product B is 2,000. So that's 10,000 units. So to see what the percentage is for product A, is the units sold of product A divided by the total units sold. So that's 80%. 8,000 divided by 10,000 is 80%. So 80% of their sales is for product A. And we do the same thing for product B. 2,000 divided by 10,000 gives us 20%. So the sales mix is 80-20. So we're going to use this information in calculating our break-even point. So as we go through here, it's going to be important to look at, although this company sells 2 products, to do our calculations, it is going to make more sense to look at it as one overall product. And we call it an enterprise product or product E. And so what we do is we look at our unit selling price of product E is going to be a combination of A and B based upon the sales mix. So we take the unit selling price for E will be $100. How do we get that? Well, product A sells for $90, and that's 80% of the sales mix. Plus product B sells for $140, and that's 20% of the sales mix. So this is where our sales mix comes in, and that gives me 100. We do that for the variable cost as well. So the variable cost for A is 70, but that's 80% of the sales mix. And then from product B, it was 95. So that's 20% of the sales mix. And then our unit contribution margin is this minus this equals this. So now this is our unit contribution margin and our selling and variable for E. We can take that information to calculate how many units or how many dollars we need to sell to break even. So what we do is take our fixed cost and we divide it by our units of sale for E, unit contribution. And so we calculated that it's $25. So that means in order to break even, this company must sell 8,000 units, but that's 8,000 units of E. Well, what we do is we take the sales mix that we calculated and we multiply it times 8,000. So for product A, I must sell 6,400 units because I take 8,000, which is product E, but A is 80% of that. So that gives me the 6,400 units. And then I do the same thing for product B. Product B, so the total amount of units I need to sell is 8, but 20% of that would be B, and so it's 1,600. So I have to sell 6,400 of A and 1,600 of B to break even. And so this just shows us, it walks us through this to show you how we break even. So that's product E. So you have multiple products, you make it into one single product, and then you break it back down once you've developed your break-even amounts. And so you can have 2 products, 5 products, 10 products. It will be the same process. Okay. The next thing we're going to look at is operating leverage. And so operating leverage is the relationship between the company's contribution margin and income from operations is measured by operating leverage. So it's computed contribution margin divided by income from operations. And so thus a company with high fixed costs will normally have high operating leverage, meaning that you can make a bigger impact when you change something within your process. So we're going to look at this. So we have two companies. They both have the same sales amount. However, Jones has a larger fixed cost, and thus they have a higher operating leverage. So operating leverage is just your contribution margin divided by income from operations. And we'll see Jones has a 5 operating leverage versus Wilson, which has a 2. They both make the same amount of money, but because the fixed cost is higher for Jones, they have a higher operating leverage. So whenever they add more money to their sales, their operating leverage is quicker and it's going to have a bigger impact to their bottom line. So percent change in income from operations can be told percent change in sales times my operating leverage. So just another tool to see how you can impact your business. So for Jones, sales increased by 10% for both Jones and Wilson. How much would their income from operation change? Well, we look at the percentage change in sales times your operating leverage. So for Jones, because they have a higher operating leverage due to a higher fixed cost, their sales are going to change by 50%, whereas the impact for Wilson would only be 20%. And so this is showing us this. So Jones has increased by 50%, whereas Wilson has only done it by 20%. So operating leverage. So again, a lot of formulas in this chapter. High operating leverage will have a large impact. Low operating leverage will have a small impact. The last thing we're going to cover is the margin of safety. So the margin of safety indicates the possible decrease in sales that may occur before your company starts operating at a loss. So how many units can I lose in sales? How many dollars can I lose in sales before I start operating at a loss? So the margin of safety can be expressed in several ways. One is dollars, one is units, and one is percent of current sales. So margin of safety, sales minus sales at break-even point. For the units, it's sales minus sales at break-even point divided by unit sale price. And for percent of current sales, it's sales minus sales at break-even point divided by sales. Now notice that the top of all of these are the same. What differentiates them is this bottom amount. And so looking at this data, we have sales of 250, sales at the break-even point, and unit selling price. So the margin of safety at dollars is 50,000. So 250 minus 200, I can only lose 50,000 in sales before I experience a loss. The units would be, the margin of safety units is 2,000, and that's 50,000 divided by 25. This should be a divide sign. And then the margin of safety expressed in a percent of current sales, I can only lose 20% of sales before I start operating at a loss. So this is important. So if you see your sales decline, you'll want to know what's my margin of safety, because if you get close to that number, then you will need to look at possibly maybe some sales promotions or something different to get your sales to increase again. And that is our chapter 19.